Everything looks calm. Markets aren't crashing. Banks aren't panicking. Your news app isn't screaming. That's the uncomfortable part. Because the most dangerous moments in financial history don't begin with chaos. They begin with relief. With the quiet belief that someone, somewhere, has things under control. For more than a decade, we've been living inside what looks like stability. Cheap money, quick rescues, smooth recoveries. Every time the system stumbled, it was caught before it fell. And slowly, without noticing, we started paying a price we don't see on statements or budgets. This is the hidden cost of cheap stability. And it matters right now more than most people realize. Let's rewind. After the global financial crisis, the world made a deal with itself. Never again. Never again allow banks to fail in chains. Never again allow markets to freeze. Never again allow unemployment to spiral unchecked. So central banks stepped in. They cut interest rates to near zero. They bought massive amounts of government and corporate debt. They promised liquidity. They promised support. It worked. The panic stopped. Markets recovered. Economies stabilized. And something subtle happened next. The emergency tools didn't go away. They became normal. Cheap money stopped being a temporary bridge. It became the road. For years, borrowing felt almost free. Governments ran larger deficits without immediate consequences. Companies refinanced endlessly. Investors learned that every major dip would be rescued. Not because markets are kind, but because instability had become unacceptable. At first, this looked like progress. Fewer recessions, less volatility, more predictable growth. But stability isn't free. It never has been. To understand the cost, we need to strip this system down to something simple. Think of the economy like a city built on elevators. Interest rates are the speed limit of those elevators. When rates are high, moving between floors is expensive and slow. People think carefully before going up. Some projects stay on the ground. When rates are low, the elevators move fast and cheap. Everyone rides. Every idea seems viable. Every expansion feels justified. Now imagine the city decides that elevators should never stop. That slowing down is dangerous. That discomfort is failure. So the speed limit keeps dropping. First, the city feels amazing. Everything grows upward. Glass towers everywhere. But elevators don't just move people. They move risk. Cheap stability doesn't eliminate risk. It redistributes it. And it delays it. Here's where the hidden math starts to matter. When money is cheap, debt grows faster than income. Not immediately visible, but steadily. Governments roll over old debt with new debt at lower costs. Companies borrow not just to invest, but to buy back their own stock. Households stretch further because monthly payments look manageable. The system stays calm because servicing the debt is easy. As long as rates stay low. That's the trade. Stability now. Fragility later. And the later part keeps getting pushed further into the future. There's an irony here that rarely gets discussed. The safer the system looks, the more risk it quietly accumulates. Banks hold assets priced for perfection. Investors chase returns in places they once avoided. Pension funds assume markets will behave forever. Nobody is reckless on purpose. They're rational inside the environment they're given. If money is cheap and backstops are reliable, caution feels inefficient. And this is where cheap stability starts changing behavior. Companies that would have failed a decade ago survive. Not because they're innovative, but because refinancing is easy. These firms don't die. They don't grow either. They linger. Capital gets trapped. Productivity slows. Wages stagnate. It's not dramatic. It's quiet. An economy that looks stable but feels strangely tired. Now zoom out. Central banks know this. They see the distortions. They read the research, but they're trapped too. Raising rates risks breaking the system they've stabilized. Keeping rates low deepens the distortions. Every decision is asymmetric. If they act too late, instability explodes. If they act too early, stability vanishes. So they move slowly, carefully, always watching markets for signs of discomfort. And markets learn this. They start reacting not to economic reality, but to policy signals. Growth matters less than guidance. Earnings matter less than expectations. Stability becomes performative. The system looks calm because everyone believes it must be kept calm. Until something external interrupts the story. Pandemic, a supply shock, a geopolitical rupture, and suddenly the math gets uncomfortable. Because debt that was manageable at 0% becomes heavy at 4, 5, 6. Cash flows that looked fine under cheap money start to crack. And now stability demands even more intervention. More liquidity, more guarantees, more promises. The irony deepens. The tools designed to prevent crisis make the next one harder to contain. This is where hype and reality diverge. The hype says central banks are omnipotent, that they can print stability on demand, that every downturn is optional. Reality is quieter and colder. They can smooth cycles. They can buy time. They cannot erase trade-offs. Every year of cheap stability increases the system's sensitivity to normal conditions. What used to be a mild slowdown becomes a threat. What used to be a rate hike becomes a shock. The floor rises, the ceiling lowers, and the room gets tighter. Here's the part that rarely makes headlines. Cheap stability reshapes power. Asset owners benefit first. Prices rise. Wealth concentrates. Workers feel stability later, if at all. Wages lag. Costs adjust faster than income. This isn't a conspiracy. It's mechanics. Assets respond instantly to cheap money. Labor doesn't. So stability looks like prosperity from a distance. And like stagnation up close. That tension builds slowly. Politically. Socially. Because when stability fails, it fails unevenly. And trust doesn't recover as easily as markets do. Now ask the uncomfortable question. What happens if cheap stability stops working? Not collapses, just weakens. What happens when inflation refuses to cooperate? When demographics drag growth lower? When debt levels limit policy choices? The system doesn't break overnight. A phrase. Volatility returns in strange places. Confidence erodes without a clear villain. Interventions feel less effective each time. And that's the real cost. Cheap stability teaches everyone to depend on it. And dependency is fragile. The paradox is brutal. The more we try to eliminate economic pain, the more sensitive we become to it. The smoother the surface, the thinner the ice. None of this means stability is bad, or that intervention is a mistake. It means stability has a price, and pretending it doesn't exist makes the bill larger. We're living in a system optimized to avoid visible failure, not to build resilience. That choice bought us time. It bought us calm. It bought us comfort. The question is whether we used that time wisely, or whether we spent it convincing ourselves that comfort was permanent. Because stability can be cheap, but it's never free, and eventually someone always pays the difference. The only unresolved part is this. When the next test comes, will we still recognize the cost? Or will we mistake calm for safety? One more time,